5 weeks of losses, the longest losing streak in nearly 4 years. Oil above $100 a barrel. Software stocks in freefall. A social media verdict that nobody saw coming. 3 separate forces hit the market this week, and they fed off each other in ways that matter for your retirement portfolio. This is the weekly market and value-aligned portfolio review from March 28, 2026. I'm going to walk you through what happened, why it happened, what the VAP portfolio did about it, and what comes next. If we haven't met, I'm Berk's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. The S&P 500 just completed its 5th straight losing week. That is the longest streak since mid-2022. 3 distinct forces drove the sell-in. A deepening US-Iran military conflict that sent oil past $100, a repricing of software and AI platform stocks on new competitive threats, and a social media liability verdict that rattled the internet giants. The equal-weight S&P 500 lost about half as much as the cap-weighted version. Small caps actually finished the week positive. That divergence tells you exactly where the pain was concentrated. Mega cap tech. Numbers for the week. The S&P 500 down 2.2%, year-to-date down 6.8%. The equal-weight version RSP down only 1.1% for the week, down 1.2% year-to-date. The NASDAQ 100 took the hardest hit, down 3.4% for the week, down 8.3% year-to-date. The Russell 2000 small caps actually gained 1/3%. That is a notable reversal from 2023 and 2024, when mega cap growth ran the table. The S&P 500 closed Friday at 6,368, sitting 8.7% below its January all-time high. It broke below its 200-day moving average earlier in the week. The VIX closed at 27.44. Above 25 signals elevated institutional hedging. The 10-year Treasury yield ended at 4.44%. Higher rates, rising oil, falling equity stocks. That combination removes one of the traditional safety valves investors count on during corrections. The sector picture split sharply. Winners and losers, no middle ground. On the winning side, energy, up 40.84% year-to-date. Oil services gained 7.6% in a single week. Oil above $100 a barrel does that. Utilities gained almost 3% for the week, up 7.54% year-to-date. The classic defensive rotation. Gold miners, up 88% over the past year, benefiting from safe haven flows. On the losing side, information technology, down 9.65% year-to-date. The software subsector got crushed. The IGV software ETF lost 7.4% in 1 week and is now down 27.3% year-to-date. Financials down 12.26% year-to-date. Communication services down 8.6% year-to-date. The economic picture this week added fuel to the fire. 3 data points converged in the wrong direction. First, GDP. The Q4 2025 revision came in at 0.7% annualized, down from the initial 1.4% estimate. Government spending fell 16.7%. That is near stall speed for an economy that needs to absorb $100 oil. Second, inflation. Core PCE hit 3.1% year-over-year, the highest since early 2024. The OECD warned that U.S. inflation could reach 4.2% this year because of the oil surge. Third, jobs. The economy lost 92,000 jobs in February. Gas prices jumped to $3.88 a gallon from $2.93 just a month ago. That 95-cent increase works like a direct tax on every consumer in the country. The Fed held rates at 3.50% to 3.75% on March 18th, an 11-to-1 vote. At that same meeting, they raised their inflation forecast and their GDP forecast. Both of those projections were made before oil fully crossed $100 and before the GDP revision to 0.7%. The Fed's own numbers may already be stale. The futures market is now pricing in a greater than 50% probability of a rate hike later this year. Read that again. Not a cut, a hike. For equity valuations, this changes the math. A forward price-to-earnings ratio of 20 times on the S&P 500 requires either earnings growth or stable rates to hold. If the market has to price in a rate increase instead of the cuts everyone expected, that recalculates every discounted cash flow model across the entire market. A quick policy note that matters. In February, the Supreme Court ruled that the IEEPA statute does not authorize presidential tariffs. 4 days later, the administration imposed a 10% universal tariff under different legal authority. The legal structure changed. The economic effect did not. So you now have a triple cost pressure hitting corporate earnings at the same time. A 10% tariff raising input costs globally. Oil above 100 squeezing consumers and businesses. And software repricing removing roughly $8 to $9 trillion in market cap from a single sector. I was working with a client recently who asked whether tariffs alone justified selling. They do not. But tariffs plus an oil shock plus a tech repricing, that combination changes the calculus for anyone within 5 years of retirement who has not stress tested their portfolio. The Iran conflict has moved from a tail risk to the central variable in global markets. The Strait of Hormuz normally handles about 20% of the world's oil supply. Right now, 4 vessels are transiting daily. The pre-war average was 120. That is a 97% reduction, not a theoretical risk, a physical constraint on supply that is already showing up in prices. Brent crude topped $106 a barrel during the week. WTI traded near $93.50 to $94. JP Morgan cut its year-end S&P 500 target from 7,500 to 7,200, citing the conflict and the oil shock. Iranian media reported that Tehran is working on legislation to impose transit fees on ships passing through the strait. If enacted, that would formalize the disruption and signal a quick resolution is unlikely. Monday brought hope. Trump described productive discussions with Iran and announced a 5-day pause in strikes. The S&P jumped 1.3%. Oil dropped 10% in a single session. Tuesday and Wednesday, that hope evaporated. Iran denied any active negotiations. A formal ceasefire proposal emerged midweek, but Iran rejected Trump's 15-point plan. Thursday was the worst single trading day since the conflict began. The Nasdaq entered correction territory. Trump extended the deadline for Iran to accept a deal by 10 days. Friday, the S&P fell another 1.7% to close at 6,368. 5 consecutive losing weeks, the worst stretch since the conflict started. What we did for a client last month applies here. We walked through every scenario, ceasefire, stalemate, escalation, and assigned portfolio adjustments to each. That is how you prepare for binary outcomes, not by guessing. On Wednesday, a Los Angeles jury found Meta and Alphabet negligent in a landmark social media addiction case. Total damages, $6 million. Meta bears 70%, Alphabet 30%. The dollar amount is small. The legal precedent is not. This is the first jury finding of negligence against a major platform for addiction-related harm. It creates a template other plaintiffs can follow. Alphabet fell 3.4% on Thursday from the verdict alone. Meta dropped about 8% combined over Thursday and Friday. The same week, 18 industry groups urged the European Commission to act on Alphabet's Digital Markets Act non-compliance. Regulatory pressure from 2 continents at the same time. Manufacturing data, Eurozone CPI, UK GDP, and the Japan Tankan survey, all on the same 2 days. That gives you a global snapshot of how the oil shock is spreading. Wednesday, ADP private payrolls, ISM manufacturing, and retail sales. Retail sales will be the most telling. Consumer spending is the largest component of US GDP, and the jump in gas prices should be visible in the March numbers. Friday, non-farm payrolls for March and ISM services. February lost 92,000 jobs, partly from transitory factors, a healthcare strike, federal workforce changes. March payrolls will clarify whether that was a one-time event or the start of something broader. Above all else, watch the Iran deadline. Trump's 10-day extension expires in early April. That single event could send oil sharply lower, hold it range-bound, or push Brent toward $120. And Q1 earnings season begins in April. Guidance commentary will matter far more than the Q1 numbers. The VAP portfolio lost 1.5% this week versus the S&P 500's decline of 2.1%. Year to date, the VAP is down 10.4% net against the S&P's 6.7% decline. That gap is real, and it reflects the portfolio's technology exposure, the worst performing part of the market in 2026. One-year numbers tell a different story. The VAP returned 11.9%, the S&P returned 12.9%. The 2026 gap is driven almost entirely by sector concentration in tech. The energy positions, Permian Resources and Diamondback, performed the diversification function they were designed for this week. The tech holdings reported strong fundamentals, but got repriced by a market rethinking competitive moats. That tension is the story of the portfolio right now. Top 5 for the week. Permian Resources, up 7.87%. S&P upgraded them to investment grade. The stock is up 54% year to date. A fundamentally improving business at the right time in the commodity cycle. Diamondback Energy, up 4.83%, hitting a new 52-week high. Multiple analysts raised price targets. Raymond James moved to $240 strong buy. Merck up 4.77%. Positive phase 3 Keytruda data in ovarian cancer this week. EPS grew 19% year over year in Q4. Pharma names benefit from the defensive rotation when tech sells off. Cisco up 2.92%. Revenue beat, raised guidance, dividend increase. Defensive characteristics attracted capital, leaving more volatile tech names. Installed building products up 1.37%, outperforming the home builders ETF by 8 points year to date. Bottom 5. ServiceNow down 9.94%. The stock is down 35% year to date and nearly 50% from its December 2024 peak. The selling is about AI agents, a market-level question about whether enterprise software retains pricing power. At some price, that becomes a real opportunity. Alphabet down 8.86%. The social media verdict plus EU regulatory pressure. The stock trades 18% below its 52-week high. The one-year return is still positive 69%. Google search remains structurally irreplaceable for most advertisers. Microsoft down 6.57%, on pace for its worst quarter since 2008. Forward PE below 20 times for the first time since June 2016. Azure growth is decelerating, but the margin of safety for long-term owners is better today than at the January peak. S&P Global down 4.29%, fell from $527 to $406 in 2 months. Deal activity is down, but the long-term thesis as financial infrastructure is intact. Ulta Beauty down 3.70%. Gas prices squeeze the consumer. The lipstick effect will be tested at $4 a gallon. The through line this week is the tension between two opposing forces. A physical supply shock pushing commodity prices higher. A competitive disruption pulling tech valuations lower. And those two forces are connected. Higher oil feeds inflation. Inflation constrains the Fed. A constrained Fed keeps rates elevated. Elevated rates pressure the discount rate on long-duration growth stocks. The Iran conflict did not cause the software repricing, but it closed off the rate cut escape valve that growth investors were counting on. The market structure story matches. Small caps outperformed large caps. Equal weight outperformed cap weight. Commodity producers outperformed tech. The 2-year bull market in mega cap tech built massive concentration risk into cap-weighted indexes. That concentration is unwinding. 3 things to hold on to. 1. The Iran situation has a defined timeline. The 10-day extension expires in early April. That deadline creates a binary catalyst. Oil above 100 is the single largest variable for inflation, Fed policy, and valuations, all at once. Watch that above everything else. 2. The software repricing is real, not a temporary dip from macro fear, a genuine reassessment of competitive moats in an era of AI agents. Some of these declines, Microsoft below 20 times forward earnings, ServiceNow down 50% from its peak, are approaching levels where the downside narrows. Earnings season in April will separate opportunity from a value trap. 3. The strategy is working across a full cycle. VAP one-year return, 11.9% versus the S&P's 12.9%. The year-to-date gap is narrow and sector-specific. Stay focused on the businesses, not the prices. Quality businesses owned at reasonable prices, held through volatility. That is how long-term wealth gets built. The past 5 weeks have been uncomfortable. They have also created the kind of valuation opportunities that rarely appear in calm markets. Next, I will break down the 3 stocks in the VAP portfolio trading at their widest margins of safety in 2 years, and what the April earnings season needs to confirm. Bye-bye.